So welcome. Thank you so much for joining us at St. James's Place today. I'm Angelina Lai. I'm the Chief Investment Officer for St. James's Place Asia and Middle East, and I'm so glad to be joined by Nick Clay, who is a Portfolio Manager for Red Wheel Global Equity Income Strategy. Just before we go into the discussions, a little bit on St. James's Place and who we are. I'm sure many of you are already clients with St. James's Place and therefore are very familiar with our story, but nonetheless, just for any of you that may still be considering joining us. So St. James's Place is the #1 wealth manager in the UK. We have just under £190 billion, which is 325 billion Sing dollars, assets under management globally. And we have been in Asia for the last 10 years, and the group itself is in the FTSE 100, and actually quite a young company within the FTSE 100, but doing extremely well. What we are really proud is that we have 1 million clients globally, and actually we have a really high retention rate, 95% retention rate, and all of that is built upon the relationship that you have with your advisors. Many of those are sitting amongst us here today. And just to explain a little bit why Red Wheel is with us here today. So this is a little bit to the unique investment management approach that St. James's Place has. What we do really well, we recognize, is the long-term wealth management approach that we have. And within the investment space, how do we translate that is we look for the mandates, the building blocks that works really well over long term to build your wealth over the time. But what we also recognize is that we can't be good at everything, and therefore when we structure these mandates, we then give these mandates out to the best managers. We look for the best managers around the globe for the mandates that we want to construct, and Red Wheel is one of these managers that we work very closely with. Without further ado, I'm glad to invite Nick to join me on stage. I'll give you the clicker. And we'll dive right in. For a little bit of housekeeping, for now we will talk for probably about 20 minutes or so, 20-30 minutes, with some of the pre-prepared questions that we know many of you have been asking. But there will be opportunities for Q&A later after the session. So do start thinking about some of the questions that you may want to be asking Nick later, and also myself if you really, really want to. Okay, so Nick, I think we can't start a discussion around investment without talking about all of that's happening in the market, even though I really want to go onto some of the investment process, etc., that we think are really unique within Red Wheel. But let's talk macro just for a minute, because I'm sure that's on the top of the mind for everyone else. Tariffs, obviously the biggest news in the market, and also driven much of the market up over the weekend. What are your thoughts? There's obviously a massive tension between US and China at the moment, and it's given the market a bit of sigh of relief for that 90 days, but it is also just a 90-day pause for this tariff, and it's not a complete take away of the tariff war. So what do you think? Do you think the market euphoria is representative of what the future actually holds? Do you think it's going to this euphoria is going to fall away as soon as some negative news come out again, or for example nothing transpires after the 90 days? Because don't forget, the first time that the trade war, I think that the first agreement really came out 18 months later. So what's going to happen? What's going to happen? What do you think?
If only I knew what was going to happen, that would make my life a lot easier. I think what's interesting, particularly about the market at the moment, is that we are now back above the highs that we were at Liberation Day, as it was called, as if it never happened. And as if the expectation is that we're just going to go back to the world which we were very comfortable with and very used to back in 2024, which is that we could just talk about 7 stocks, we can just talk about AI, and everything goes up, and we don't need to really worry about anything else. And I think that is pretty naive. I think that it is pretty clear that things have changed, even if everything just reverts back to a 10% tariff, which, the first so-called deal on the table was the UK, and that basically went, it's 10%. Even if we get to that with China and everybody else, that is still a dramatic change in the backdrop that we face. That is a tariff level going back to what we haven't seen since the 1970s. And quite frankly, therefore, pretty much every manager, including myself, who, as you can tell, I'm pretty old, but I'm not that old, and all the managements of my companies have never known an environment with tariffs that are that escalated. And it matters, and the reason why it matters is because we're using the wrong term. The term shouldn't be tariff, the term should be tax. And the reason why these aren't going away is that those taxes are required by America. And the reason why they're required is because Americans' government, just like Europeans' government, just like the Chinese government, have way too much debt and spend way too much money. And I've got a chart on that. Which you can see here on the way you're looking at it. On the left-hand side, you can see the debt to GDP in America is back up to the levels we saw at the end of World War II. That is unsustainable. If you look at their current interest bill on their debt alone, and then you look at their Medicaid and their Social Security commitments, that is 97% of all the money that the US government brings in every year is spent on just those three things. So we haven't got to defence, we haven't got to anything else. Okay, they cannot sustain this. And as you can see from the middle chart, they continue to like to spend money. Their deficit spending doesn't get any better, it gets worse. So you've got three options as a government when you're spending more money than you currently bring in. One is that you can go, I'm sorry, I'm going to default on all the debt, because I'm never going to pay it back. The chances of that happening are basically zero, I would argue. There's no way the US are going to default on their debt. So the second thing is the government stops spending. Well, as you can see from that middle chart, the chances of that happening seem pretty low as well. But what it does mean is they desperately need some taxes. Now, Donald Trump particularly has already promised everyone who voted him in that he's going to renew his tax bill that he put in place the first time round. And so he's told them he's not going to put up income taxes, he's not going to put up corporation tax. So the only tax he's got left is tariffs. He has to call them a tariff because the only person in America who can change taxes is the Congress. But the government, or the president, through an executive order, can change tariffs. That's why they're called tariffs, but they're really a tax. The real way you get yourself out of this situation, and this is ultimately what this is all going to be about, is inflation. That is the only way you get yourself out of this problem. And it is the way we got ourselves out of the problem after World War II is through inflation. Up to the end of the 1970s, you can see it goes from 120% of debt to GDP to below 40, because you grow the GDP. You get the GDP to go up nominally because of inflation. That is what we are now trying to do again, is get inflation going. And I find it quite interesting that the only thing that's brought inflation down since the pandemic is goods inflation. Service inflation is still running at around 4.5% in the US, and tariffs are inflation on goods. And so you can get the inflation getting back up again. The average inflation rate in the 1970s was 6.6% in America. We all panic when it hits 3 at the moment. 6.6. 3, the numbers don't work. We do not bring it down that quickly. And so we are looking really at a situation where we are getting a regime change. We are getting a change where we are now having to actively seek inflation around the world to sort out the debt position that we have with the governments. That is a very different environment to how we've been investing for the last 30, 40 years, basically, since the 1970s. And it's something we need to think very carefully about how we manage our money through that.
That's great. Segue into my next question, which is, okay, so how do you manage, what does this mean for investors, right, in the room? How do you manage investment in this potentially highly inflationary environment? Is it to put everything in cash because, you know, market's really volatile, but actually then you see all of your money eroding away from potentially 6% inflation rates? Or actually, what are there other places where you can be thinking about protecting your wealth over time?
So we have to go back to a period of inflation. So we've got to go back a long way, and that's back to the 1970s, and try and look at what worked. And the worst performing asset class over the whole of the 70s was cash, for obvious reasons. This is in a real sense. The second worst was treasuries, for the same reason. And equities was the third worst performing asset class.
Interesting.
Yeah, which is interesting. because a lot of people think equities are an inflation hedge. What you really need is some real assets, so a bit of gold and commodities. But within equities itself, there were a couple of things that did work very well. And back then, it was deep value, and it was also income. And the reasons why those two things worked so well in that environment, is in a very volatile environment, and in the 1970s, the market went up and down by about 40%, because inflation doesn't go high and stay high. Inflation goes in big waves. So in the 1970s, the lowest inflation got to was, this is in America, is 3%, and the highest was 18%. It goes in these big waves, and it's the big waves that cause the volatility in markets. Now, back then, deep value worked because everything did go in a wave. Mean reversion was very prevalent, and it held true. So if you had a discipline to buy cheap enough, then it would mean revert, and you were fine. The difference this time round is that disruption is far greater today than it was in the 1970s. The average tenure of a company in the S&P in the 70s was 60 years. Today, it's 20 years. Particularly technology and the effect of globalization has meant disruption has grown. So the idea that just buying something very cheap, deep value, was going to work again, I don't know if that's true. However, income and what worked for income back then, all of that holds true today. So there are three things that made it work. Firstly, dividends can grow. Companies are effectively nominal. They can grow their cash flows, they can increase their prices, and therefore they can grow their dividends. So the dividend growth over 12 months of the S&P matched CPI over that period. So from a real sense, you can protect your wealth through the growth in those dividends. It's how you suffer as a client. The second thing is that when things go up and down, which we're so unused to, because we're used to things just going up in a straight line these days, but when things go up and down, mathematics tells you the negative numbers are far more important than the positive numbers in determining your total cumulative return. And therefore doing something about not losing money, lowering your volatility, having a lower downside capture in your market becomes much more important than making more money on the way up. And yet, since 2008 and QE3, we have all been trained, like Pavlovian dogs, to think that we just make money at the moment, and everything goes up. And we're all going to be rich by Monday if we buy Bitcoin on a Friday. That is how we have been trained. We have not been trained to remind ourselves that not losing money is far more important than making money if things are volatile. The thing about income investing is that if you're buying a company based on a dividend yield, you're buying it on a valuation discipline. And that margin of safety helps you with your volatility over the long term. And if you're making the most of your total return from the compounding of your dividend, that is lower volatility than the capital return, so it works. The final thing is valuation. Again, everyone has forgotten about valuation being a key metric, and you can see that in this chart, the one on the left. Every time we go through these cycles, and we did it going into the 70s, where we march up a small cohort of the market to the tops, and we think we are utterly certain every time that these are the only things you want to own. Going into the 70s, it was the nifty 50. Those 50 companies could do anything and everything, and they were amazing companies. Most of them still exist today, PepsiCo, Exxon, GE, brilliant companies. When the market fell 46% at the beginning of the 70s, they fell 85%. Because the valuation they were on was so high they could not live up to the expectations that valuation demanded of them. This time round, we're even more certain. We've gone from 50 stocks to 7. We are utterly convinced that this time we only need 7 companies and AI-related companies. And yet again, we march them back up to stupid valuations and stupid concentration in markets. And yet, this time, we're utterly convinced this is all you need to hold. The difference is that when things become volatile, when you go through economic cycles, slowing, faster, etc., inflation, interest rates going up and down, it is far more difficult for a company to deliver consistently on those expectations demanded of it. Now, when your valuations are sky high, you better deliver perfection in order to keep going. And if you start to stumble at any point, then you really get hit hard because your valuations have no forgiveness in them. starting to think about valuation again becomes very important when things get volatile. At a time when everyone in investing today is being encouraged to get closer to the benchmark. It's been encouraged to just buy the S&P because it always outperforms, doesn't it? It's been the best performing market out of 8 of the last 12 years. It's the only thing you need to own. The irony of that is in order to so-called reduce risk, we are being encouraged to get closer to the riskiest thing out there. And that is what happens at the extremes in market. And it's why you need a discipline imposed upon you to stop yourself finding yourself in the rank of the insane at the top where everybody's investing in the same thing. And those 3 characteristics are going to be the key thing going forward.
Indeed, that's really interesting and very much sort of aligned with some of our views, particularly in terms of the narrowness of the market. We've been talking about the extreme markets. My last CIO letter talks about sort of the fat tail risks that we are currently seeing in the market, especially sort of to your point around the 7 biggest companies forming over 30% of S&P 500. What that means is that other 493 companies within the S&P 500 basically are only 70% of the entire index. That is quite concerning, I guess, or high risk, if you will, from a concentration risk perspective. And we really agree. I think we're very aligned from the valuation perspective. I really liked a quote that I heard recently. The equity market pricing tend to be really the expectations for the future, i.e. technically usually analysts will be doing price models around what's the future earning potentials of these companies. But to your point, actually, how much earnings would these, especially the Mag 7, have to achieve in order to be able to give out the valuations that they're currently on? And therefore, we do also very much agree that actually a lot of the S&P 500, and actually because S&P 500 or the US market is almost 70% of MSCI ACWI, at the moment, a large chunk of your sort of passive investment, if you will, if you're getting closer to the benchmark, to your point, are actually quite concentrated in these really highly valued companies, driving that narrowness risk. But let's come back to, therefore, what do you believe will generate that longer term consistent returns for clients, particularly during these kind of volatile markets? How do you and how does Red Wheel see from your selection of companies? How do you find these companies that potentially have the pricing power to be able to pass on to some of these inflation risks and fundamentally, therefore, then match the inflation risk that our clients would hold in their portfolios? And essentially, what are the metrics that you look for, and what are some of the stories or success stories that you might be able to share with us?
So, I mean, we're a bit old-fashioned, and I'm not very clever, so I have to try and keep things simple so that I can actually do it. And when we look at what drives long-term returns in markets, and statistically what was it, you can see that pretty much everywhere you look, at every academic study, all the data, that the compounding of the income is the largest driver of your total return over the long term. Now, no one cares about the long term, because everyone just cares about the weekend. But when you look about building wealth over the long term, then that is the largest driver of your compounding. You can sort of see that on this chart on the right. You know, that is the equivalent of, you look at what's happened in the S&P since the 1970s. You put $1 in, you got $64 back from your capital return. You then reinvested the dividends, you end up with $291. It utterly dominates, and you can see it gets bigger and bigger the longer and longer you give it. Now, the most powerful investment tool I think you all have at your disposal is time. But the hardest thing about harnessing time is volatility. Because we are human beings, and we're all weak as human beings, and we get scared, and we get greedy, and we get all those emotions, and I get exactly the same. And therefore we are forced normally to do the wrong thing at the wrong time. And the best thing to do is kind of try and not do anything. But you have to therefore invest it in something which is generating or creating your wealth slowly over time.
Sorry, I was just going to say, by not doing anything, you mean keeping, I think you're translating our language as being disciplined.
Disciplined,
yes.
Exactly right. Being able to stay invested and not being forced to do the wrong thing at the wrong time. And so we're the same. And so we impose disciplines upon ourselves to try and ensure that we're doing exactly the same thing. We are forced to buy companies that yield 25% above the market, and we're forced to sell everything that yields less than the market. So that keeps us out of really expensive stuff. We can't get involved in the Mag 7, doesn't matter how much they go up, nothing we can do about it. And equally, it forces us to buy good companies when they're looking cheap. And of course, when they're looking cheap, something's normally going wrong. So it's quite difficult to buy things at that point. A really good example of that at the moment is luxury retail. The whole world knows the Chinese consumer's never going to buy a handbag again. Well, I don't know, does that sound like a permanent state of affairs, or is it just a temporary thing, maybe to do with a lack of confidence, considering the fact their net worth has actually grown over the last few years and their property collapsed? Sounds more like a confidence thing to me. But what's good about for us in our strategy is that we're paid to wait. So we can buy those luxury companies and then get a yield of 4% off them, which we can compound in our funds as we go forward. And we're paid to wait, even though it's a very uncomfortable thing to do. At the same time, we're forced to sell everything that's expensive. So last year, we were being forced to sell our TSMC in our portfolio and told we were utter idiots to be doing that, because obviously TSMC is going to take over the world because it makes all the chips for AI. Which fool would be selling TSMC? It was just too expensive. Now, at the time, it feels really difficult. With hindsight, it was actually not a bad timing. And it's those disciplines that give us the faith that you can invest in the right kind of companies at the right valuation at the right time. Now, this strategy has been in place for 20 years, so we've got enough evidence now to show that that tends to tell us to do the right thing at the right time. That means the things we're invested in today, to your point, is that are those companies that can suffer in an inflationary environment. Which are the ones that have pricing power? Well, the ones that we want to invest in are things like staples, utilities, luxury retail, which have massive pricing power, insurance, things where they're either selling things like shampoo and deodorant, which hopefully in every environment we're going to have to carry on buying, so they can put up their prices. Insurance is a legal requirement, therefore they can put up their premiums. Luxury retail, it doesn't really matter what price Cartier is selling their Forever bracelet at. That's not why you're buying it, it's because it's cheap. You're buying it because you want it. To utility companies which are allowed to push through inflation. And what's helpful with this is we did have a very small window or insight into this in 2022 when inflation came back after the pandemic that demonstrates all those companies we own were able to suffer very well in that environment, push up their prices and keep their demand resilient. That allowed them to grow their cash flows and grow our distributions. So our distributions over the last 12 months are growing by 7%, keeping up with core inflation. And knowing that we're just compounding that over time and building that wealth slowly, and the longer we do it and the longer we get our clients invested, the more and more that starts to dominate your total return. Now, the compounding of that income is far lower volatility than the capital gain in your portfolios. So the longer you give it, the more it reduces the volatility, which then allows everyone to stay invested for the long term. That's key right now, as that left-hand chart shows, because we go through these big cycles of what's going to drive your wealth. This goes back to the 1950s. The black line shows you the starting valuation of the US market, and then the coloured bars behind show the next 10-year returns. You can see that when that black line is low, you get some really good next 10-year returns. And when it's high, you get much lower ones. But what's key is the red and the dark grey. Because when it's high, the dark grey dominates for the next 10 years. The compounding of the income dominates your total returns. When it's low, the capital does really well. Well, right now, we're pretty much near the highs. We know we're moving to a new environment. We're coming out of the environment of QE that we've had after '08, and we're moving back into a new environment of normality, of cycles, volatility, and therefore the compounding of your income is going to become even more important going forwards. So having something that's disciplined and focused upon that, when everyone else is focused upon getting rich quick, is going to become very important for the next 10 to 5 years.
That's really interesting. So let me, and quite a lot there, so let me try to summarize a little bit my takeaways from what you just said. 3 key points that I got away from this. Number 1, discipline investment, really, really important for you. That's something like you buying at 25...
Yep,
25%.
it's got to yield 25% above the market to
You
buy
have to
it.
yield 25% above the market, and you have to sell
And
it
we
at.
have to sell it when it yields less than the market.
Okay, and you keep to that discipline no matter what happens,
Doesn't matter what
including the Taiwan Semiconductors example last year. Number two, what this means is that it tends to drive you into more defensive type of products, which obviously works really well in this kind of environment. And number three, actually the income generates really important to reinvest it, because that is your longer term generation. So we have a lot of clients asking us, oh, we like income portfolios because I like to have a yield sitting in my portfolios and a cash because it keeps me happy emotionally. But actually, I think what you're saying is that what you are really looking for is the type of stocks and companies that gives you that kind of yield, but it's really important to reinvest it into these kind of stocks, because then it compounds the return as shown on the charts, right?
It's the eighth wonder of the world, as Einstein.
Great, so that's really, really interesting. I just want to talk a little bit more about discipline, because you touched on this a little bit, and we were obviously talking about this sort of this mentality of buying for the weekend, right? Everyone sort of wanting to have that euphoria of, oh, my holding just went up 25% overnight, and I feel rich again, right? But obviously the downside of that is that can also happen to the negative, pretty much. And this is sort of why in your strategy you much more look to the defensive. So let's talk a little bit about that discipline. You talked about the red wheel discipline. I just want to talk about how do you reflect from a client's perspective? What does a potentially a disciplined investment approach might look like for an investor sitting in this room?
It's harnessing that time. It's being able to remain invested over the long term and not be forced into having to do the wrong thing at the wrong time. Now, what enables that is to not be fragile. What do I mean by that? It means investing in companies which, were they to have a drawdown, because we go into a massive bear market, for example, and were they to have a drawdown, that the business itself is not then forced into doing the wrong thing at the wrong time. It's not forced into selling off its assets at the wrong time. It's not forced as in to pull back its investing in its own business to maintain those cash flows over time, and that it carries on paying you a dividend. You looked at the pandemic. I mean, that was an example of probably one of the biggest slowdowns we've had as an immediate stop. Lots and lots of companies could not suffer. They were cutting their dividends. And that is the worst case scenario as an investor, because it's at the dividends at the lows in markets, when you're reinvesting them at the lows, you have the biggest impact in your compounding going forward. But you've got to have those dividends to reinvest. So you've got to have companies that suffer. It's the same for clients. You have to be in a position you can suffer, i.e. suffer the volatility. Now, that's hard to say. So if you can get yourself into strategies which are less volatile, that enables you to be able to suffer the volatility that comes in markets. The problem with the environment we've been in for the last few years is everybody thinks there's no risk anymore. Everybody thinks that as soon as the market has a bit of a panic and throws its toys out of the pram, that the government or the central bank will come over and save us. And they'll make sure, and we have narratives for it. There's a put, there's the Powell put, there's the Trump put. They were all implying that markets just will never go down and you'll never lose money. Now that means you end up forgetting about risk, and you just take on more and more risk. I mean, my goodness, there's levered ETFs on Nvidia, like it doesn't go up enough that you have to lever it 2, 3, 4 times. And you're just taking on more risk on the basis that there is no risk. And that is a position where you cannot suffer. Because when things start to go difficult, as we've seen in the last few months, then you're forced to do the wrong thing at the wrong time. If you're forced to sell your capital at the lows of the market, that's a disaster, because you will not then participate in the recovery of the market. We know over the long term equities do go up, but they don't just go up in a straight line forever. They do, and they are more volatile, and that's what you need to better suffer.
That's really important, and I think sort of again translating this to some of the SJP speak, our advisors will often sort of be talking about this, and almost the number one we talk about is actually what's a risk appetite. I join quite often sort of client meetings, and where clients are saying, hey, my private banker is saying that if I put in this investment, whether it's the latest tech stock or whether it's the sort of private equity or private credit, the flavor of the month, I would get a double-digit return. And then my question is, okay, so what is the downside risk? Okay, so what is it that you can withstand in these? because when the market or when your portfolio is down 30%, how do you feel about this? Are you feeling that you want to run away and hide and therefore take everything out just to feel safe? Or what are the actually conversations? So a lot of our conversations should be, and a lot of these is about, yes, there's absolutely a longer term upside, and the longer your time horizon, I'm an actuary, so I like to talk probabilities, the longer your time horizon, actually it almost goes to closer to 1 that your portfolio will go up in value, particularly if you're investing into the right things, keeping to the disciplined approach and everything to the plan. But at the same time, you need to be aware that the downsides do happen. And when these downsides happen, and it's usually much better to be talking about that when the market is doing well or the market is sort of doing normal, right? Not in a sort of volatile environment where you might be feeling really anxious. To be thinking about taking out the emotion, what should I actually be doing? Actually, the ideal thing to do is to be buying the dip. I know you are saying that that's sort of the flavor of the month at the moment, but really buying at the dip and selling or taking a bit more profit when it's going up, which fundamentally actually is sort of what your investment strategy is sort of saying. But your metrics are sort of with the yield. So that's really interesting, and that's a very interesting disciplined approach. I just want to talk very quickly about also the SJP's portfolio, because obviously the red wheel strategies and the mandates, etc., are part of our building blocks, right? So they're part of what we usually construct for you. We do also then manage your portfolios on a more holistic basis. Usually your advisors will be talking to you about what are your goals, and then how do we achieve those goals, and what are your risk appetite? Because, for example, actually someone might have that risk appetite. I do want to invest in some tech stocks and be subject to, potentially 100% rise, but I'm okay to take a 30-40% downside. But some of them might want to be taking sort of more the defensive approach, and that's how we construct some of the portfolios in relation to that risk appetite. But also in these kind of times is where we're then going, what are actually the risks? So to your point, risks change over time. That doesn't change with sentiment. Risks change over time, and there are market metrics, etc., that we measure. And then we actually then look at comparative valuations. Is that risk worth taking from a portfolio perspective? So really from SJP perspective, we also follow a very disciplined approach in how we look at what's known. So we actually have these factors that are what's known, what's highly influential and not known, and therefore our approach may be more to diversify, and what's not known and what's not influential, right? And a lot of that are to do with the emotional aspects. So hope that helps. It's been a very interesting conversation. I'm sure there's lots of questions in the audience. So I'll sort of pause here and just see whether there are there any questions, burning questions up.
I know the message is long term, but now we've had the relief rally from the tariff.
Just to make sure.
How do you?
I'll repeat myself. I know the message is long term, but now we've had the relief rally with the kind of tariff situation at the weekend, and whether that will change or not, probably. But what would you say is the next driver behind to keep the market to keep going up, essentially?
What's the next driver to keep the market going up?
Is it AI? Is it something else?
I think if I was the market, which I'm not obviously, but if I was the market, what I'd be now looking for is a speedy and fast progress and resolution of the tax bill renewal in America. So, what happened the first time with Trump was he did the tax bill first, and then he did the tariffs later. So he did the good news first, and then he did some of the bad news later. This time he sort of started with the bad news, with the idea that he can get his tax bill through later, which is, in most people's eyes, going to be good news. And the reason why it's going to be good news is, one, it needs to be renewed. Yeah, and we are definitely of the view that it's going to get renewed. If they do not renew this tax bill, and his tax bill we put in place ends at the end of this year, so it has to be renewed this year, that is a nightmare, because corporation taxes are going up, income taxes are going up, it will be a disaster, and America will collapse under that scenario. So it's going to get renewed. But what the market wants, as always, is more. So if you renew the tax bill as it currently stands, that's an extra $5 trillion of revenue that the US government does not receive. Okay, so it's an extra $5 trillion of debt they're putting on. But the market wants more than that, and Trump's promising more, so he wants more tax giveaways, which could take it up to, if he gets everything he wants, $11 trillion of deficit spending, effectively. This idea that governments do not want to save money, they want to carry on spending money. So this time round he had to start with taxes. He had to start with, I'm going to raise some money somehow. That's the whole point of tariffs, is to prove that he can raise some money. And he thinks he can raise, I don't know, $600 million a year or something like that, which doesn't really touch the edges. But it's some kind of sop to Congress to say you've got to put this tax bill through. That is what the market is now looking for, to try and push it ever higher. I would argue that the market has bought into the Trump narrative of this is the start of the golden age of America. But when you look at markets and how they've performed, we've had the golden age of America. We've had American exceptionalism already. As I said, the S&P has been the best performing equity index 8 out of the last 12 years. And it basically came from when they started doing QE3. And they pumped their market way much, and then you had more QE during the COVID pandemic, plus government finances going through the roof, and deficit spending. We've had American exceptionalism. Now, if you think mean reversion is broken as a concept, and you think that the US, as a weighting of the MSCI world, which is at 71% today, but it can go to 80%, it can go to 90%. Maybe we could just have one equity market and it's just the S&P, who knows? And maybe we can just have 7 stocks and we don't need to worry about anything. If that is true, you don't want to invest in the way we invest. We will be a disastrous fund under that scenario. You want to go and buy some sex and violence tech stuff. If mean reversion holds true, and it is basically the founding stone of capitalism, is mean reversion holds true, then we've already had the golden age of America from a stock market point of view. And therefore, I think this constant looking for what's going to take the American market higher and faster than everywhere else in the world is a misled question or a misled view from the market. I think what's now in train is that we're moving away from American exceptionalism to the rest of the world, where valuations are far more acceptable, far more realistic. I mean, Asia and emerging markets particularly, have been terrible performers for a long period of time. There's some great value starting to appear in those Asias. Europe's been pretty, and the UK, given Brexit, has been pretty awful over that period of time. Almost everything's been awful compared to America. There's much better value to be had elsewhere. And the question really is more, what gets them going? And you are starting this idea that America's just going to do what it wants, and no one else is going to respond, no one else is going to adapt or change, is obviously nonsense. And what you really want to look for is how are Europe and Asia and China going to respond and change? And that's where the advantages and the opportunities are going to lie, and that's where I'd be looking today.
Yeah, I'll just add to that point also, from very much aligned to our house views at this perspective, and then I'll link that back to valuations, which I talked about, and where the best risks are to take. Really, we look at everything from a valuation perspective. Is overvalued versus their own historical values, and where they are sort of from a percentile perspective, and therefore, and also then sort of what are the risks on the horizon, and therefore how do the valuation compare with that risk, right? So we're always sort of paying a risk premium. And actually, for sort of the last year, we've been saying actually we think America's overpriced. We think there's a massive concentration risk, i.e., the risk premium is not particularly worth it. Whereas we see much more attractive opportunities elsewhere, such as the emerging markets, such as UK, Europe actually has been something that we've been finding quite favourable over sort of the last year or so, and we are sort of much more overweighting our portfolio positions, which obviously has done quite well in the recent market environment. What's really interesting is that over the last 2 months since Liberation Day, actually, where sort of this market market for, or US market for at least, what that's done is actually brought some of the valuation gap or valuation extremes we're observing closer. which then means actually we're most going, actually we feel that spring, right, that extreme spring are potentially actually getting slightly less tense, and therefore maybe we were looking at whether we should be revising our views and actually maybe more look at US again, because could actually be more interesting valuations, could there sort of be good companies there. This recent rally has brought the valuations back up. So really sort of that from our perspective, we look at it from a valuation, same thing that you look at dividend yield and sort of from a disciplined approach, we look at valuations versus the risks and the extremes that we're observing in the market. So really sort of what we're sort of saying is that when everyone is going in, so I mean I think in 2021 everyone's calling it FOMO, at the moment everyone's saying buy the dip. But really when everyone is putting their money into a specific market, whether that's AI, whether that's US, usually we're kind of going, ooh, could that already be overvalued? Because by the time that it reaches to the general investing public, usually that tends to get it to be a more, it means that it has overvalued. I guess the other thing that we tend to say is that equity market is the only marketplace where when the shop goes on sale, everyone runs out of the shop. And the opposite is true, right? When everything gets really expensive, like your luxury goods, everyone's tend to sort of be putting their money in, which again, from when you look at it from a non-emotional perspective, doesn't particularly make very good sense.
We're all human beings and we're all weak.
That's very true. Question over there?
Thanks, Vidya. You mentioned you've recently removed diamond semiconductor from the portfolio. Can you maybe mention something that you've put into the portfolio recently and the investment kind of philosophy around why you chose that particular stock?
Yeah, so we sold our TSMC and put it into LVMH. So as I said, it's highly disciplined what we're doing. We have these strict buy and sell disciplines, and for 20 years we've never been able to buy LVMH. It has never been cheap enough for us to be able to buy. And in the fourth quarter of last year, when we had sort of peak Chinese consumer angst, and nothing else cared apart from AI, the luxury retailers underperformed so much that they have got themselves down to a valuation where the free cash flow yields on these stocks are heading towards 5 or over 5, and in certain cases like Kering, which is Gucci, it's up around 8. They are effectively discounting in a valuation that the Chinese will never buy a handbag ever again. And when you can go back over the whole history of these companies, and you can see that, one, they're nowhere near as volatile as people think they are, not unsurprisingly, because their client base tends not to be that exposed to economic cycles. And secondly, that particularly during recessions and slowdowns, they do incredibly well. Even if you go back to the Japanese bubble, and you look at some of the quoted companies back then, Bulgari, for example, was quoted back then, and you look what happened to Bulgari sales over the next 5 years, it was bigger, even though the bubble burst in Japan 5 years later. They are far more resilient than people give them credit for, and their business models demonstrate that historically. And so unless, and I'm looking at people's handbags as I'm looking around this room, unless people have decided that's it, we do not want to buy luxury ever again, and that as the growth in the middle classes increases, there's no aspiration anymore. Unless that is true, then you're getting a great opportunity to buy into what are incredible quality companies being priced as if they are broken forever. Now, if the Chinese consumer is in financial ruin, then that could well be true, but there is no evidence to suggest that's the case. If the growth in the middle classes around the world has stopped and is not going to happen anymore, so there is no more aspiration, well then they are broken businesses. That doesn't seem to be true either. There's no evidence to support that. And so we think that these are temporary phenomenons in these companies, and therefore a really good entry point into these companies. Now, whether the Chinese consumer will turn this quarter, next year, who knows? I have no idea. And we're not clever enough to ever pick the bottom in these things. But I don't care because I'm being paid my dividend to wait, and I can compound that dividend. The rest of the stocks in my portfolio, and some of them that are working, and some of them we're still waiting for. And as long as I have that, then that's fine. I can wait until they finally turn right.
Sounds quite interesting, and really sort of actually the market dislocation or the extreme concentration that we're seeing when everyone's putting their money into tech AI. You are finding opportunity, I guess the gold in the sand, as you say, right? Any other questions? Just following on that one, I will ask a slightly naughty question, which is actually, have there been any examples of stocks or companies that haven't quite worked out to your very disciplined approach, and what have you learnt from it?
Yeah, all the time. We're constantly making mistakes, and this is what I would call a probabilistic industry. We are going to get plenty of things wrong as well as get things right. And all we're trying to aim to do is that we get slightly more right than we get wrong, literally over 50%. You go back and look at the best fund managers ever over history, they get it right 52% of the time. I mean, that is terrible, it sounds pathetic. But actually, that's all you need to do. I mean, the other thing they do is the 48% of the time they don't get it right. They don't lose as much money as everybody else because they understand the risk better. So those combination of those two things is what you need to do, be able to generate really good real wealth for your clients over time. And that's what we're trying to do. So we get it wrong all the time. The latest one we got wrong was Bayer. So we bought Bayer when it was under a lot of concern because of litigation. Litigation is a repeating pattern of an interesting time to look at stocks, whether you've looked at tobacco stocks in the past, pharmaceutical stocks, oil stocks. It's a times of litigation that is actually normally a really good time to look. Bayer, and sorry, I'm going to go a bit tangential now, sorry. So most managements of most companies are terrible managers. They are terrible at allocating capital. And that, of course, is the problem with, or the difficulty most growth investors face, is because they want the company to invest everything for growth, and unfortunately most companies' management are terrible at doing it. And Bayer is a great example of this. They went and bought Monsanto, which is where all the litigation came from, and it is probably one of the cataclysmic capital allocation decisions ever. And we thought the litigation would play out that they would settle for about €10 billion, 10 billion euros, and the market cap had fallen by about 40 billion euros, and therefore we thought it was overdoing it. And for a while, that was completely true, and it was starting to come right. And the settlements had come through, and then suddenly the courts in the US started ruling against them again. And so that meant at a time when they built up the debt in their balance sheet because they hadn't been generating the cash, made them more fragile as a business, and then the litigation was coming back again, meant we got this wrong. It was not mean reverting. And that meant that the risk of the dividend was suddenly going through the roof, and the chances that they were going to cut it, they were losing money, so we sold the stock. 2 months later, they cut the dividend, and now, even today, they're still struggling with the litigation that has not mean reverted for them. So what did we learn? We learned that we have to be very careful about those mean reversion trends and which ones are really going to get right. What are the questions we need to ask? We need to spend a lot more time looking into. It didn't matter what the reasons were in court for them to suddenly start losing, and they were nonsense reasons. That was irrelevant. Because now it just meant the probability of, say we were all class action people who were setting bar, and we were going to settle for an average of $69,000, and then suddenly someone wins in a court for no reason whatsoever, but gets offered $10 million. Now my incentive is solid, let's just go to court and roll the dice and see what happens. And that elongates the process and massively increases the cost of the whole thing again. And it doesn't matter whether it's true or not, it just would cripple the company. And so that's why we had to learn that for any other litigation, like J&J at the moment's one in our portfolio where we've still got litigation overhanging.
Okay, very interesting. Hopefully you've minimised the losses you made on that.
We did. This is 20 years history of this strategy gives us enough statistics now to show that are these disciplines encouraging us to do the right thing at the right time more often than not. When you look at all the sales we make, 62% of the time, it is the right thing to do. It's the right thing to sell the thing and put the rest of the money back in the portfolio. The portfolio does better over the next 12 months than the thing we sold, 62% of the time. And that's all we need to do. And so, and Bar is a good example. It's gone on to underperform the portfolio since we sold it at the end of 23. Even though we'd lost money on it at that point, but to this point, 48% of the time you're going to get it wrong. Just don't lose everything when you get it wrong. Realise you're getting it wrong, get out, minimise your losses and move on to something else. Understand, accept you're going to get lots of things wrong. That's what has to happen.
Very good. Question over there.
Just a quick one on economy and then investing. So US has announced a 90-day tariff freeze or a cessation, right? And now recently, with the discussions with China, again there's a 90-day between the two of them. Because of all this, the stock market has sort of rallied. And so the question is, how should an ordinary investor look at this? Is it just a temporary phase, and is it going to go back to where it was, and then is it all going to tank? Is this over optimism? And how do you process incidents like this in terms of what next to do and how we should, process it ourselves?
So I definitely don't think we're going back to the way it was in 2024 when everything just goes up in a straight line. I think we're in a more volatile environment. I think the idea that Trump's just going to roll on all of his tariffs and everything's going to go back to the way it was is very low because they need the taxes, so they need to raise money somehow. And so there is a difficult environment that we now face. And the idea that every negotiation is going to go as smoothly as possible, and that we're going to do global trade deals in 90 days, and they're all going to be perfect, and there's going to be no unintended consequences to those trade deals that no one saw coming. When we can spend 5 to 10 years doing trade deals and then 6 years later realise that was a complete waste of time and it was a stupid thing to do, is naive in the extreme. So there will be lots of things that go wrong, and there will be lots of things that come back to bite the market and upset the market. What do you do from an investing point of view? Well, personally, I'd say I would ignore it and go and do something else that's more interesting and not bother to watch it, because if you're investing in something that's disciplined and growing your wealth over a long time, who cares? From my perspective, I don't have that luxury, obviously. So what we've got to do is, as we say, have the ability to suffer. What that means is remain flexible. So it's taking advantage of that volatility. So for example, during the pandemic and the volatility, that's when we bought TSMC back. That was the third time we've owned TSMC over the 20 years in this portfolio, because it got absolutely crushed during that period and we were able to step in and buy it. Now we sold it. This time round, what I find is quite interesting is that, sticking with AI, we are totally believe in AI. We are very much of the belief that everyone's going to have it, because it will commoditize, which is why you don't want to buy Nvidia, but everyone's going to get it. And then what's interesting is over the last few months is that IT services companies like Infosys, like Capgemini, have been absolutely hammered. They're down 40-50%. And yet if you roll out AI to major clients, as we're all finding out when we look at AI, you need a lot of help to make it work for you and make it work in the way it should do. That is going to require IT services companies. This is not an app you're going to buy on your phone and just plug it into your business and it's all going to work. It needs a lot of help. And therefore we think that's the next growth leg for those businesses, and yet they've just fallen 50% in share price terms. So we bought some Capgemini, we added to some emphasis over that period. Being flexible, we're not forced to sell stuff at the bottom when things have fallen because we can't suffer it anymore. And that then allows us, and because we're outperforming in the times when things are falling, the stuff we own does very well. The fund's up quite comfortably in an absolute sense so far this year, even though when the market was hitting its lows. That means we've got stuff we can just sell, because we can take our profits and use that money to buy in the opportunities that are now being presented to us. And as I say, this discipline of a yield of 25% means these names sort of come into our universe. They dip in and then sometimes they dip back out again. And so what we're watching for are what are the stock names that are falling in? Do we recognise them? Do we know them to be quality business? Are they things we've never been able to own before, like LVMH? Oh my goodness, finally we get that. Occasionally, a really good business drops in and we still don't like it. We still don't think it's... L'Oreal is another example of a business that's come into our universe for the first time in 20 years, but we still think it's expensive. So we're not going to buy that. But that's what we're doing, is trying to take advantage of the opportunities being presented to us. Because the market, the way it is at the moment, is things don't stay down for very long at the moment. because of the mood set of the market, that it wants it to go back up again, buy the dip, everything's always going to be fine. You have to be quite nimble and quite quick to be able to do that at the moment, where historically you've always had a bit more time to do this. It's time to have to be a bit more quick. So that's why I'd say for this room, the best advice is to just switch the TV off and go and do something far more constructive and interesting in life. For me, and my job is that we've got to be a bit more nimble, but then that's fine, because we've been following stocks for a very long period of time, and so we can act quickly when we need to.
And you have a disciplined approach which you follow.
That's right, precisely. And the disciplines tell me what to do.
And I think that really comes back to the central point, I think, my central takeaway from this discussion, which is the disciplined approach, and even more so, I guess, in a volatile market like this. Try to take your emotions out of it. Think about a disciplined playbook. Agree that with your advisors. And just whether that's you are putting monthly money in at certain times and just not think about it, etc. And just trust that your portfolio managers are doing and looking for opportunities for you in the market. And really is sort of my key takeaway. So stay disciplined. Thank you so much. I see the desserts being served, and I hope you enjoy the discussion. We're still going to be around for a little while, so do come and talk to us. And thank you very much for your time.
Thank you, everyone. Thank you.